I want you to start by picturing two completely different high-stress environments. So in the first scenario, you are standing in the control room of a nuclear power plant,
Okay.
and suddenly an alarm starts blaring. A pressure gauge is just spiking straight into the red, with absolute certainty that you have a finite number of seconds to make a decision before the core overheats and a meltdown becomes physically inevitable.
Right, so high stakes, high pressure, and governed entirely by the laws of physics.
Exactly. Now, I want you to cut to scenario two. You're in a boardroom, top floor of a global bank. A report slides across the mahogany table, and liquidity is draining fast. The stock price is tanking. X is just lighting up with rumors of insolvency.
Well, I mean, ideally, the coffee's a bit better in the boardroom, and you aren't wearing a hazmat suit.
You would definitely hope so. But the argument we're unpacking today is that while the furniture is different, the math required to survive those two scenarios is actually almost identical. And it all comes down to one single merciless variable, which is time.
Time. It really is the universal constraint. And this comparison, it's not just some metaphor we came up with to make banking sound more dramatic. It actually comes directly from the source material we're deep diving into today.
Which is a fascinating white paper.
Yeah, a really fascinating paper titled Quantitative Response Time and Escalation Modeling for Banking Probabilistic Risk Assessment.
That is quite a mouthful.
It is a massive mouthful. We can just call it QRTM PRA for short. But, don't let the acronym scare you off. The insights here are incredibly grounding. It's written by Lev Nemotin, PhD, from N5 Digital. And this is where it gets really interesting because Dr. Nemotin isn't your typical Wall Street quantitative analyst.
No, I was actually looking at his bio and I had to do a double take. He's not just a guy who spent his whole career moving money around on screens. His background is deeply rooted in nuclear security, AI and embedded infrastructure, and medical safety critical systems.
Right. He spent his career looking at systems where failure isn't just, a bad quarter for shareholders. It's a crater in the ground or a patient dying on the operating table.
Yeah.
So he's taking the rigorous probabilistic risk assessment, or PRA, that keeps nuclear cores from melting down, and he's applying that exact same engineering logic directly to the modern digital banking system.
Which makes a lot of sense when you really think about it. Banks today, they aren't just vaults with gold bars sitting in them. They are these massive, digital, highly automated networks. So the aha moment for me in this paper was Nemotin's argument that traditional banking models are essentially asking the wrong question. They keep asking about probability, like what are the odds of us losing money?
Exactly. And Nemotin argues that in a world of digital banking, viral panic, algorithmic trading, the real risk isn't just probability anymore, it's velocity.
Velocity.
So the mission of this deep dive is to unpack this framework, to really understand why modern banks fail and why measuring your seconds to collapse is actually way more important than measuring how much cash you have locked in the vault.
So let's unpack this. We need to start with the core philosophy here. Probability versus velocity. Because usually, when I hear about bank risk, I just hear terms like capital adequacy or default rates.
Yeah, that's the traditional view, the old way, if
Right.
you will. It's very static. It basically asks, if X happens, do we have enough money to cover it? It treats the bank like a fortress. If the walls are thick enough, meaning if you have enough capital reserves, you're safe.
But Nemotin is saying that's outdated.
He's saying it's completely insufficient now. He points out that systemically important banks operate as critical national infrastructure. They are digital, they are automated, and crucially, they are highly confidence sensitive.
Right.
The key insight from the paper is that recent failures, if you think about the sheer speed of the Silicon Valley Bank collapse, for instance, they often happen not because the bank misunderstood the odds of a problem, but because their response was just too slow relative to the collapse velocity.
Collapse velocity. I mean, that sounds terrifying.
It is. But think about Nemotin's background again. In nuclear security, survival depends on whether the defensive response happens before irreversible damage occurs. It's not just about preventing the attack itself, it's about the speed of your countermeasure. Or look at his work in medical safety.
Oh, right. The paper mentioned escalation failure in surgery.
Yes, in a surgical theater, if a patient starts crashing, the risk isn't just the complication itself. The fatal risk is often escalation failure, which means waiting too long to call for help or to change the procedure. Because if you wait too long, it doesn't matter how skilled the surgeon is, the damage is already done.
And he's applying that exact lineage of high consequence risk assessment to banks. He's effectively saying a bank run is basically a physiological crash.
Precisely. Just as a human body can only go so long without oxygen, a bank can only go so long without liquidity. And in a digital world, the oxygen gets sucked out of the room so much faster than it used to.
Okay, so if speed is the name of the game here, how do we actually measure it? This brings us to the math part of the deep dive, but I promise you we will keep it painless. The paper introduces something called the resilience inequality.
This is the golden rule of the entire framework. It's a very simple formula. TRL needs to be less than BLST.
Okay, let's break those acronyms down for a second. TRL needs to be less than BLST. Let's start with the second one first, the BLST.
BLST stands for Baseline Liquidity Survival Time. Think of this simply as how long can the institution hold its breath?
Holding its breath. I like that visual.
It's the amount of time the bank can survive under extreme stress. Massive withdrawals, market panic, credit freezes, without any external help. It is a literal timer. It could be 30 days, it could be 48 hours, or in a full digital panic, it could literally be 4 hours.
So that's the survival timer. Now, what is the TRL?
TRL is total response latency. This is your response timer. It's how long it takes the bank to figure out it's actually drowning, decide what to do, and then actually swim to the surface.
So the rule is your reaction time, the TRL, has to be faster than your survival time, the BLST.
It is that simple. And frankly, that brutal. If TRL is greater than BLST, if it takes you 5 hours to execute a rescue plan, but you only have 4 hours of liquidity, the system collapses.
It's basically like a leaking boat. It doesn't matter how strong the hull was originally. If the water is coming in faster than you can patch it, and you take way too long to find the bucket, you sink.
And this framework forces banks to stop just staring at the hull and start looking at the bucket, or rather, looking at how fast they can find the bucket. The paper argues that a lot of institutions are deceiving themselves because they think they have a week of survival time, but modern factors have completely cut that down to hours.
Which brings us to a really scary question. Why does the clock tick so fast? The paper talks about something called the strategic fragility module, and this is what determines how long you can hold your breath.
Right. This is what sets your BLST. Nemo makes a really important distinction here. Fragility isn't the event itself. It's the pre-existing condition. He compares it to structural fatigue in engineering.
So the bridge collapses because a heavy truck drove over it, but the actual reason it collapsed was the rust that had been sitting there for 10 years.
Exactly. The truck is just the trigger. The fragility determines the survival time. And the paper lists very specific factors that shorten that survival time, effectively speeding up the collapse clock. One of them is liquidity structure stability.
Which is basically just, whose money do you actually have?
Correct. Do you rely heavily on uninsured deposits from tech startups or hedge funds? Because that money is hot. It can flee at the click of a mouse. If your deposit base is volatile, your survival time is naturally going to be very short. Compare that to a bank holding small retail savings accounts. Every day, people rarely wake up and panic withdraw their life savings at 3 a.m.
Another factor mentioned was leverage expansion velocity.
Steep kills. If you are growing your risky exposure much faster than you are growing your capital reserves, you are masking fragility with profit. You look incredibly successful on the quarterly earnings call, but you're actually thinning out your survival buffer. You're building a taller tower without deepening the foundation.
The paper also mentions incentive risk bias. This is the classic bonus culture problem, right?
It is, but viewed specifically through the lens of time. If your bonus structure consistently rewards short-term profit over long-term survival, you are effectively incentivizing your staff to ignore the rust on the bridge. But more importantly, it creates a culture of silence.
Silence, like people not speaking up.
Exactly. If the messenger gets shot or just loses their end-of-year bonus for pointing out risks, nobody pulls the alarm. And if nobody pulls the alarm, the response timer doesn't even start until it's way too late. That brings us to governance independence. Can the chief risk officer actually pull the alarm? Or will they be silenced by a CEO who just wants to keep the stock price up? If they can't pull that alarm instantly, your TRL goes up and you're inching closer to that inequality flipping.
And one more fragility factor that felt very modern, very now AI synchronization exposure.
Oh, this is a massive emerging systemic risk. Are your automated systems all essentially doing the exact same thing? If every trading bot and risk algorithm is programmed to sell when a certain metric hits, you don't get a gentle decline. You get a sheer cliff.
Because they all literally rush for the exit at the exact same millisecond.
Exactly. That compresses your survival time from days down to minutes. A human panic takes a little bit of time to spread. An algorithmic panic is instantaneous.
So that's the survival timer. Let's look at the other side of the equation now, the human side. Why are we so slow? The paper details a human reliability and governance module.
This determines the TRL. And Namoten breaks response time down into 4 distinct phases. This is straight out of his nuclear and medical background. It's a classic breakdown of exactly how humans fail in complex systems.
Okay, lay them on me. What's phase one?
Detection time. How long until you actually see the red light flashing? Now, in a modern bank with real-time dashboards, this should be fast.
Should be. But then comes phase two, which is recognition time.
And this is the critical one. It's the time between seeing the red light and actually interpreting it correctly as a full-blown crisis.
It's about overcoming denial.
Exactly. In a control room or a bank or an airplane cockpit,
Right.
there's a massive amount of psychological friction. You see the liquidity dropping and you immediately think, it's probably just a reporting glitch. Or the market will bounce back by noon. Or we really don't want to overreact and spook the shareholders.
And that hesitation right there, that's where the battle is lost.
That hesitation is the difference between a minor market correction and a total collapse. It adds crucial minutes or even hours to the TRL.
Then we get phase three, escalation latency.
Getting the right people into the room. This sounds trivial, but it's often where the whole system chokes. Can you actually find the CEO? Is the board off on a retreat? Do you need a strict quorum to sign off on emergency funding?
It's the bureaucracy of panic.
Bureaucracy of panic is a great way to put it. If it takes you 4 hours to get the signatures to release collateral, but you only have 3 hours of cash left, math wins.
And finally, phase four, countermeasure activation time.
Actually pushing the button, deploying the liquidity, calling the regulators, issuing the public statement. The paper makes a really fascinating point about this entire sequence. Response time is measurable, and it can be rehearsed, just like a fire drill.
That's a great point. You would never run a nuclear plant without meltdown drills. But do banks run bank run drills?
Namoten argues they absolutely must. And not just polite tabletop discussions over catered lunch. Real-time simulations. It's 2 p.m., deposits are fleeing, the CEO is totally unreachable, you have 30 minutes, go. If you haven't rehearsed the physical mechanics of the response, you are going to be too slow when it's real.
But there is a nuance here that Namoten points out, which is very unique to banking. In a nuclear plant, the reactor doesn't care if you trust it. Physics is physics. But a bank...
A bank only works if you trust it. Money is effectively just frozen confidence.
Precisely. Which leads us to the confidence dynamics module.
The X factors. In banking, confidence actually influences the system behavior. The paper introduces the confidence decay rate, or CDR. How fast does the public lose faith?
And in the age of social media, that decay rate has to be off the charts.
It's the digital multiplier. Social media and digital banking apps mean money can move instantly. Information or misinformation spreads instantly. This accelerates the collapse velocity to a point where human decision-making almost cannot keep up.
It's not like the old days where you had to physically stand in a line at a branch to get your money out. That physical line slowed things down. It gave the bank time to talk to people, to calm them down.
Now the line is invisible, it's infinite, and it's instant.
The paper also talks about initiating events. Obviously, you have cyber breaches or bad strategy. But the one that really stood out to me was AI origin events.
This is the absolute frontier of risk. We touched on synchronization earlier, but consider model misclassification. What if the AI controlling your liquidity defense interprets a stress signal completely incorrectly? Or what if it's a malicious manipulation of the automated system, an adversarial attack on the model itself?
If AI is running the show, it might crash the system at machine speed before a human even pours their morning coffee.
And because all these banks use the exact same tech stack, we have the cross-institution correlation.
A contagion effect.
Namoten calls it the CICI, Cross-Institution Correlation Index. If Bank A and Bank B both use the same cloud provider or the same AI risk models, a failure in one isn't isolated anymore. It propagates. If the market sees Bank A fail because of an algorithm, they naturally assume Bank B is next.
It's like if everyone on a capsizing boat rushed to the exact same side at the same time because their survival manuals all told them to do the exact same thing.
Exactly, and the boat just tips over instantly.
There is one more player in this game of time we have to address, though, the referee.
The regulators.
Right, the paper discusses the regulatory interaction variable.
Namoten points out that it's not just about the bank's speed. It's heavily about the central bank's speed.
Because if the bank is drowning, the central bank is the lifeguard.
But if the lifeguard hesitates, if there is ambiguity. Are we going to bail them out? Are we not? Is this a true systemic risk or just bad management? That hesitation from the regulator directly compresses the survival time for the bank.
We saw this in recent crises. The weekend suddenly becomes this frantic window to save the world before markets open in Asia on Monday.
Credible, fast support extends the survival window. Ambiguity just kills it. The regulator is fundamentally part of the inequality equation. Their reaction time adds directly to the bank's TRL.
So when we look at this whole picture, we're seeing a massive shift. The old way was building a fortress and hoping the walls held. The new way, this QRTEM PRA framework, is all about agility.
It's about recognizing that modern banking is a highly complex, high-velocity system. Emoten isn't saying we should just throw out the old capital models. We still absolutely need capital. But he's saying capital is necessary, but no longer sufficient.
The missing dimension is time.
In an environment where things move at digital speed, where automation and social media completely run the show, stability isn't about being too big to fail. It's about being fast enough to survive.
That distinction is so crucial. You can have all the money in the world, but if you can't deploy it before the confidence hits zero, you're just done.
And that applies to everyone in the ecosystem. The board of the bank, the regulators, the risk officers, they all need to be looking at their watches, not just their ledgers. They need to understand their own fragility, not just measured in dollars, but in minutes.
It really changes how you look at the headlines. When you see a bank in trouble now, you stop asking how much did they lose, and you start asking how fast are they moving.
And how long can they hold their breath?
Before we wrap up, I really want to leave you with a thought that struck me while reading Emoten's conclusion. We've talked so much about how digital speed is outpacing human reaction time. The confidence decay rate is faster than a board meeting can be convened. The AI synchronization is faster than a phone call to the regulator.
It raises a profound and, frankly, somewhat unsettling question.
If our financial systems are now operating at speeds that effectively outpace human deliberation, are we reaching a point where only AI can save us from an AI-driven crash?
It's the paradox of the loop. If we insist on keeping the human in the loop, does the human actually become the biggest risk factor simply because we think too slowly? Our biological processing speed hasn't upgraded in thousands of years, but the market speed upgrades every single millisecond.
So do we just hand the keys over to the AI?
If we do, we might just ensure we crash faster and more efficiently.
Or we let the AI fight the AI, and we just hope we survive the collateral damage?
That is the ultimate dilemma the industry has to answer. And looking at the velocity of these charts, they really don't have much time to figure it out.
Well, on that slightly terrifying note, that wraps up our deep dive into the world of QR and PRA. Huge thanks to the source material, Emoten's white paper, for giving us a totally new, sharper lens to view the financial world.
It was a real pleasure to unpack it. It's dense, but it is absolute essential reading for anyone watching this space.
Thanks for listening, everyone. Keep your reaction time sharp. We'll see you on the next deep dive.